Robschild. No investment advice. Welcome to the show where we view financial markets through crystal ball gazing. JP Morgan once said, millionaires don't need astrologers, but billionaires do. And so we begin. Today is Thursday, July 25th, 2024. Sorry I've been out for a few shows. I didn't have access to anything for a few days, but I am back in today's episode. Main theme of the day, markets look bearish, but leading indicators say, actually, from my perspective, believe it or not, as bearish as I've been, say buy the dip for now. If you watch Gareth Soloway's show, if you're this deep into markets watching my show, I assume that you're watching his because he's got a great show as far as patterns go, and all of his insights. And the main thing from him that I got today was that there's a lot of broken trends out there, and that the broken trends are cracks in the ice. And even though there are a lot of cracks in the ice, I don't see enough cracks to suggest that we're in all out panic, total fear mode yet. And it's mostly from the fact that junk bonds aren't collapsing here. But we'll go through the charts. I also found today notable headline from CNBC that OpenAI announces a search engine called SearchGPT. Alphabet shares dip. I laugh just because I remember when Google was new and everyone started switching to it because it was better and cleaner and more useful, and yeah, Alphabet is a tech giant. And I don't know how, depending on how old you are, you might remember the fact that every so many years a new search feature, search engine takes over. Google didn't exist forever. There were the most popular search engines have changed dramatically over time. There's a YouTube video actually that goes through the trends of who was the main search engine, and it's changed over time many times. For so long, Google's been the kingpin here, and people forget that kingpins fall. I think this might be the end of Google, to be honest. I will not be using Google anymore if ChatGPT has a search engine. I won't. I won't do it. So I find this to be very big news, actually. Sorry, the last screen I had it double there. So main data came out today was the GDP for quarter 2 of 2024. This is, gross domestic product of the United States. Basically, when it's up, it's good. It means that people are producing and buying things, at a good rate. When this really goes down, that's a problem. That's a big problem. And so the last reading of this was 1.4. Expected was 2.1. It came out at a very high 2.8. But I will note here, look out for the revisions. Many times revisions end up telling that this number is not as pretty as it looks right now. It might even be as low as what was even expected. Also, daily reminder, 2-year, 10-year yield curve inversion has passed its second birthday. This does indicate that pretty strongly that we are headed into a pretty bad recession. Historically, this is a very good indicator. It's not one to forget, and I'm going to talk about it every single day until we uninvert, at the very least. Also, look out tomorrow, Friday, for PCE data. That's kind of the main number of the week to see where inflation is right now and where it's headed. Again, the PCE is the Fed favorite for the inflation data. So the first chart of the day I want to bring up is the CME group page of the possibilities of rate cuts, or where the Fed funds futures contracts are basically pricing. And I do want to note that there is a currently priced in 0% chance that we will not cut in September. I find this very notable for the September 18th meeting. 88.6% chance of a 25% 25 basis point cut and an 11% of a 50 0.5 percent cut. And I find this very, very notable that there's over 1/10 of a chance that there's actually going to be two cuts, or either considering that we may or may not cut apparently in 6 days from now, still a 7% chance there, but that there's even a higher chance that there might even be two cuts by the time we get to September. I find that very, very notable. Jumping over to the VIX futures curve, again, these are contracts that price out volatility in markets, and normally the price is lower sooner and it goes higher over time, and we see a huge bump going into October of volatility cooling off, and so we have some backwardsness going on in the VIX futures curve from October through December. I mean, it is seasonal, but it's kind of combining everything here, right? We have a cut in September, which typically means a slowdown, and so October is getting quite a good bid here, and then we actually see it cool off all the way through December on these contracts. I find that to be very interesting. So this market says anyway, potentially a very big crash, happening in October, at least in equity markets. On to SPX, or the SPY, whatever you want to call it, the S&P 500. This is a weekly time frame chart. You can see, it's Thursday, and this is the second large red candle in a row. Granted, all the way back, starting from March of 2024, I had been talking about this looking like the three black crows kind of a scenario. Very, very, very bearish looking pattern here on a weekly basis, and it was a rip your face off kind of rally here for anybody that went short here, because we just climbed higher and higher. I mean, maybe that's because too many people were short, including expecting turnover here, and that's why the market went up. It's all psychological. They're all people involved. Could this be the top? Could this be the the rollover here? Yes, I think it can be, but it's not enough cracks for me to say we're in a bear market right now necessarily, but that could be forthcoming. And I'll get to the junk bonds. That's the main chart that gives me a reason for that. This is the S&P 500 on a daily time frame. Obviously, this does not look bullish at all by any means, but myself and everyone else that looks at markets sees very clearly, the last time we thought that we were headed, into a bear market, it turned into a rip your face off rally. And so what does that usually mean? It usually means, we'll find some major support here at this line. I would suggest, maybe even getting again to all-time highs. Again, the trend's your friend till the end. Are we at the end? I don't know. Additionally, the NASDAQ, the Qs, QQQ, looking very bearish for the moment. But again, every time people buy the dip, they're rewarded. And so, and you can't control what other people do with their money. So can this be another rip your face off rally to the upside? Definitely can be. Would I participate? Would I buy here? Absolutely not. Mostly just because of my macro view of the fact that, we're headed into the cutting cycle. That's when the recession always starts, every time. It's not hard to see this coming. It would be very strange to not have a recession or a depression right now with the yield curve inversion, and especially coming out of the yield curve inversion. We cut, suddenly we're uninverted, and we all know what happens. But for the moment, we are in fear mode. CNN, Fear and Greed Index agrees. TLT, You know, this big black line represents a huge inverse head and shoulders that if we crack above it and confirm, especially on a longer time horizon, this could be very bullish for bonds. But for now, yeah, we've been slightly bearish. Inside day today says that I mean, in all likeliness, we're very likely headed to this line for another bounce. And I think we will stay within this range and eventually crack above this black line here, which if I zoom out again, this represents, I can't see it all, it doesn't go back far enough, but a longer term head and shoulders pattern that I think will play out. As you might know if you're following my show, I am highly exposed to this. I think it's the best, most undervalued, unloved asset out there, and I'm highly exposed to it myself. Again, with the yield curve, I don't know if you can see very well, the bottom shows the duration of treasury securities, the duration. So you have 1 month all the way through 30 year. And it's not scaled very well. You know, between 20 and 30 years is very much longer between federal funds rate in 1 month, right? But it sort of makes them all even between the different securities that are available. But the main point of bringing this up is the fact that the 5-year is now below the 7-year. And as the yield curve inverts towards a recession, we will see if this 3-year, the next step. So before we had the 5-year above the 10-year, right? And now the 5-year is below the 10-year, below the 7-year. The next step would be to see the 3-year drop below the 5-year, and then the 2-year drop below the 3-year, and then the 1-year drop, you know, and so on, as we get through this cutting cycle. It's pretty clear to me in my crystal ball that one rate cut is not going to suddenly send inflation going back up to the moon. Markets are cautiously, they're overly optimistically believing that that's still going to happen right now, in my opinion and my crystal ball reading. But we'll see. So the main reason why I say this is still considered a buy the dip opportunity, at least for today, right? Tomorrow PCE data, we could see a humongous crack in HYT to the downside, and that would be bearish. But for now, it's funny, you know, the S&P, the 500, the NASDAQ, all these stock indices are preparing for some giant crash, and high yield corporate is just coiling up here, getting ready for a break. When it does break, I imagine it'll be fantastic. I imagine it will be to the downside, but will that happen tomorrow or sometime later? I don't know. I can't see that in my crystal ball. And so for now, I actually say buy the dip, even though I wouldn't do it myself. I wanted to bring up uranium. This is a ETF URA. I had mentioned, I just wanted to show off that my charting skills here, that I did identify this head and shoulders top, basically confirmation that we were headed to the downside. That has proven to be true so far. Notably, yesterday, silver dropped by almost 4%. Very large move down, finally sort of breaking out of this sideways motion. I have been talking about how crazy silver has been going, how every pattern seemingly to want to give the market a signal, just going the other way, just ripping the face off of any trader that's trying to use any kind of chart patterns to trade this, is just, at this point, I imagine, has just given up and said, you know what, I'm not trading silver anymore. Let's see what silver does. You know, and right now it's cracking down, and this is partly because of the fact that silver is an industrial metal. When it's expected that markets will decline silver, it can act as a leading indicator, so it's getting a little bit of a drop here. Again, I think it's overall overvalued, and so the way that I look at silver right now is not really like losing tremendous value, but maybe returning to maybe even a normal value. I wouldn't consider silver cheap until it's at least below $20 an ounce. I shared some charts in a while ago in previous shows showing why I believe that. It has to do with the price of silver versus the prices of other things. Last two charts I want to share today, IWM. This is the Russell 2000. As you can see, this is a no-brainer pattern here. This is called a bull flag, right? We're tightening up after a move up, and so the expected move is to explode to the upside. However, any wedge can explode down to the downside. What traders will do is they'll wait till they break above this line here and then confirm it, and they'll buy there and then and ride the wave up. I think this is like obviously prepping for the PCE data and what may come out of that tomorrow, actually. So this is a market to keep your eye on. Last chart of the day, my poor Nissan stock dropping 6% today. Buy the dip, and it just keeps dipping, like they say, the memers say. Again, with Nissan, I have been talking about how I think this is an undervalued stock. I think it's even more undervalued now. I'm not fear selling here. I see thousands of new Nissans on the roads today. I don't think they're going out of business. They've had their troubles, but are they going bankrupt? I mean, if they do, for me, with a 5% of allocation to this, if I were to lose that, it's not the end of the world. The risk is worth the reward, in my opinion. And right now, it's priced as if it's going bankrupt. So, will it? I don't think so. Anyway, that's all I have for you for today's show. Sorry for missing some previous shows. I was basically on vacation, but I'm back for the regular shows now. Hope you enjoyed. Thank you for watching Robschild.